higher level than what we saw in December. We're sitting at 54.6, and as I mentioned, the highest level since April 2010.
Yes, good afternoon, Eleni. It's a wonderful level. It's nice and strong. We're picking up, and I think it shows two things. Number one, it shows that perhaps the number that we saw in September and October was an aberration in terms of the strikes that had an impact then. Perhaps that impact was bigger than we think. Yeah. But also, this is a very strong number, and it's underpinned by extremely strong new sales numbers. Now,
but that's been driving PMI even in the month of December.
Yes, although it's picked up handsomely. Now, that means that the order books of the new sales orders of the manufacturing sector is very strong, and that's also a very high weighting in the index. Now, that could be ascribed probably to two reasons. Number one, local demand is really picking up, and the strong demand we saw in the third quarter is spilling over into the fourth quarter. And secondly, we are seeing stronger international demand. So overall, it's good news. The order books, the new sales orders are looking strongly. Business activity was slightly disappointing, still above 50, but it was disappointing. I, however, do think...
Because that declined by 3.5 points.
Yeah, it's still above 50, but yes, it declined. But if you now look at the new sales orders, one would find that probably the business activity will pick up in the next month or two as these new sales orders are starting to filter through the through the inventory line.
Because shouldn't they be aligned, the business activity and the new sales order in a way down the line?
There should be. There's a lag. Obviously, you get the new sales order, you get the order, and then you enter into manufacturing it. So yes, there will be a lag, and that's why we believe that the drop in in business activity shouldn't be concerning. It should pick up in the next month or two.
You know, employment is just one of those things that keeps filtering through month after month. It's still below 50. It's
the 9th month in a row that we're below 50. Now, on the good news side is the rate of deterioration hasn't increased. We actually increased the number. It's still below 50, but it's a lot better than the last few months. The key is, however, if the new sales are going to come through the system as expected, I believe, and I hasten to predict, that we might be at the end of the negative numbers in employment, and we might in the next month or two start to see that positive.
All right, let's look at the global PMI space. We had China out with its official PMI number falling to 52.9 in Jan from 53.9 in December. What is of concern, though, is that input prices are rising. And this is also synonymous with what we're seeing in South Africa.
Yes, although those numbers are still nicely above 50, the key element is that if you look at the input costs in South Africa was the highest it's been since December 2008. And we're seeing the same trend internationally. So what are we seeing? We are seeing the effect of the higher oil price, of higher commodity prices on the input side. And I do think that will continue. And even if you look at it further, there is a link between our input costs on the PMI and the oil price. And I do think that means that PPI in South Africa, production price inflation, will start to come under pressure as we continue during the line. It also means that in the world overall, higher commodity prices is going to start to have an impact on prices, on inflation, and on interest rates going forward.
Oh, I mean, what do you think the biggest challenge and threat is for the PMI number in South Africa going forward? I mean, one only has to look at what's been happening within emerging markets, and I was talking to Rob Tal a little earlier, and he said it's going to be a big play between funds coming out of emerging markets because of worries of political instability spurred by what we see in Egypt, and perhaps going into the cheaper developed world.
Yes, Eleni, remember there's two things. You either talk about the markets look for yield, and the markets are forward-looking. And we have seen tremendous flows into the equity and bond markets of the emerging markets. When you talk about the PMI and you talk about the underlying economy, this is the real economy. It's not necessarily the market. It's what's happening in the underlying economy, consumer demand, production numbers, factory output. So this is more to do with the real underlying economy and not the market economy. If you look at the real underlying economy, our risk is twofold for the manufacturing sector. Number one, local demand. We are seeing stronger and better local demand, and as we've seen in the official numbers for the third quarter, it was nice and strong. This shows us that perhaps that continued, as well as economic activity in our export countries. And when I mean economic activity, I'm not necessarily meaning where the capital is flowing in terms of equity markets. I mean, what is the underlying economy doing and how is the consumer reacting? And as long as we're seeing strength in the underlying economies and demand picking up in the underlying economies, we will see the manufacturing sector doing well.
What about, I mean, looking at the price index, you mentioned 71.3 from 63.1 in December. That's a jump of 10 points. We're also seeing similar levels like that going forward as well. Is this going to be a big hindrance, the inflation outlook?
Yes, as long as input costs remain high, which we are seeing. And if you couple the higher oil price with a weakening of the currency, as we've seen in the last few weeks, that pressure will, we are going to import some. And we're at the highest level since we've been in December 2008. So for more than 2 years, we haven't seen the input pressure or the the price pressure as high as this. So yes, I believe that we will see that feeding through into our production price index.